Impact analysis: anticipated 30% revenue decline in automotive electronics and pharmaceutical sectors by Q4 2025. Date: February 1, 2025. Executive summary. By the fourth quarter of 2025, significant revenue declines, projected at approximately 30% across the automotive electronics and pharmaceutical sectors, are anticipated. This downturn is largely due to economic shifts, regulatory changes, and increased competition. The implications for global competitiveness in these industries are profound, necessitating urgent strategic adaptations. 1. Automotive industry challenges. The automotive sector is experiencing a notable contraction driven by falling demand in key markets including Europe, North America, and China. In 2024, U.S. automotive production declined by 5%, with major players like Volkswagen and BMW reporting staggering profit drops, 63.7% and 61% respectively. Contributory factors include high fixed costs. Traditional manufacturing processes remain expensive, straining profitability. Electric vehicle EV competition. The shift towards EVs presents both an opportunity and a challenge. Although there is growth potential in the electric market, the withdrawal of government subsidies in some regions is curtailing consumer interest. Regulatory pressures. Increased regulations, particularly in Europe, are pushing manufacturers to adapt rapidly to more stringent environmental standards. The narrative surrounding EVs remains crucial. While manufacturers strive to transition, the landscape is complicated by changing government policies and fluctuating consumer preferences. Analysts suggest that without significant innovation and adaptation, traditional auto manufacturers may struggle to maintain their market positions. 2. Electronics sector impacts. The electronics industry is similarly positioned for a downturn, facing challenges such as reduced consumer spending. Economic uncertainty has led consumers to cut back on discretionary purchases, impacting sales. Inventory management issues. Many firms are grappling with excess inventory, prompting strategic adjustments to production and supply chain management. To combat these challenges, companies are increasingly focusing on innovation and efficiency. Strategic investments in research and development are expected to be pivotal in navigating the anticipated revenue declines. 3. Pharmaceutical sector dynamics. Traditionally viewed as a resilient sector, pharmaceuticals are not immune to the impending economic shift. Key factors include regulatory changes. Anticipated reforms in healthcare policy may result in increased pricing pressures affecting revenue. Market saturation. With many markets nearing saturation, pharmaceutical companies may find it challenging to sustain growth without breakthrough innovations. As companies adapt, maintaining a focus on compliance and regulatory alignment will be critical to securing market share. 4. Economic and regulatory influences. The broader economic landscape is marked by volatility influenced by interest rates and inflation. High interest rates have suppressed consumer and business spending, while inflation continues to drive up operational costs. Geopolitical tensions. Ongoing global conflicts and trade disputes could further complicate market dynamics, particularly post-2024 elections, which are expected to bring about significant policy shifts. 5. Investment in innovation and technology. Despite the anticipated declines, there is a notable push towards innovation, particularly in clean technologies. Investment trends indicate that over $31 billion was directed towards clean technology initiatives in 2024. Key areas of focus include electric vehicles. Continued investment in EV technology is seen as essential for long-term sustainability. Artificial intelligence (AI). Companies are increasingly looking to AI to enhance operational efficiency and drive innovation. Common key points. Across the automotive, electronics, and pharmaceutical sectors, the need for adaptation is paramount. Companies must embrace digital transformation and sustainable practices to remain competitive. The overarching themes include operational resilience. Firms are focusing on improving operational processes to weather economic fluctuations. Customer engagement. Enhanced customer experience strategies are being implemented to retain consumer loyalty amidst declining sales. Differences between sources. Source 2 primarily emphasizes the automotive sector, detailing specific earnings impacts and challenges facing manufacturers. Source 3 offers a broader manufacturing perspective, highlighting trends in digital transformation and clean technology investments. Timeline of events. 2023, automotive production initially recovers driven by pent-up demand. 2024, revenue declines become evident across all three sectors, with major companies reporting significant profit losses. Q4 2025, a 30% revenue decline solidifies, prompting strategic shifts in production and investment. Conclusion. The anticipated 30% revenue decline across the automotive, electronics, and pharmaceutical sectors by Q4 2025 underscores a critical juncture for these industries. Companies must prioritize innovation, strategic investments, and operational excellence to navigate this challenging landscape and maintain global competitiveness. The emphasis on adapting to changing consumer preferences and regulatory environments will be key to future success. This report serves as a comprehensive analysis of the projected challenges facing these vital industries, providing insights for stakeholders to strategize effectively for the future. The anticipated 30% revenue decline in the automotive, electronics, and pharmaceutical sectors by Q4 2025 presents various counterintuitive points that challenge conventional wisdom about these industries. 1. Resilience of the pharmaceutical sector. Traditionally viewed as a stable and resilient industry, the pharmaceutical sector is expected to face significant revenue declines due to anticipated regulatory changes and pricing pressures. This perspective contradicts the common belief that pharmaceuticals are largely insulated from economic downturns. The expectation that governments will exert more control over drug pricing to manage healthcare costs could undermine the sector's perceived immunity and challenge the notion of its stability. 2. Electric vehicle EV market dynamics. The automotive industry is undergoing a significant transformation towards electric vehicles, which is often seen as a growth opportunity. However, the anticipated decline in revenue may seem counterintuitive given the push towards EV adoption. The potential cessation of government subsidies for EV purchases in Europe and changing consumer preferences could deter demand, contradicting the widespread belief that the EV market will continue to expand unabated. This points to the complexity of market dynamics where supportive policies can quickly shift due to economic pressures. 3. Investment in clean technologies amid declining revenues. Despite the expected downturn in revenue, there is a notable increase in investment in clean technologies, particularly in the automotive sector. This situation presents a paradox where companies are channeling resources into innovation and sustainable practices even as their revenues are projected to decline. The assumption might be that companies would cut back on investments during downturns, yet the opposite appears to be happening as firms prioritize long-term sustainability over short-term profitability. 4. Labor market stabilization yet persistent challenges. The manufacturing sector is experiencing a stabilization in the labor market, with a decrease in the number of job openings alongside a reduction in labor turnover. This scenario may defy expectations that a declining economy would lead to a surge in unemployment and labor shortages. However, while the labor market seems balanced in the short term, manufacturers still face significant challenges in attracting and retaining skilled workers, highlighting a disconnect between employment stability and the ongoing skills gap. 5. Geopolitical factors and supply chain complexity. The assumption that supply chains will stabilize following the pandemic is challenged by ongoing geopolitical tensions and potential disruptions. With significant global elections on the horizon, changes in trade policies could exacerbate supply chain challenges. countering the idea that the worst of supply chain disruptions is over. This indicates a more complex landscape where political factors continue to significantly influence logistical operations. 6. Digital transformation investment trends. The shift towards digital transformation in manufacturing may seem like a logical response to economic pressures, yet the scale and urgency of these investments are counter to the expectation that companies would pull back during downturns. Manufacturers are increasingly prioritizing digital tools and technologies despite the challenges, indicating a recognition that long-term competitiveness requires sustained investment in innovation even in the face of declining revenues. 7. Consumer spending patterns. While consumer spending is seen as a stabilizing force in the economy, the anticipated decline in revenues suggests that consumer behaviors are shifting in ways that may not align with historical patterns. The expectation that consumers will continue to prioritize spending in the face of economic uncertainty may prove overly optimistic, as evidenced by the reduced demand forecast across multiple sectors. 8. Growth in EVs versus declining traditional automotive sales. The automotive sector's pivot towards EVs is often viewed as a positive trend. However, this shift may not translate into immediate financial growth for all manufacturers. The decline in traditional vehicle sales as companies transition to EV production could create a paradox where overall automotive revenues decrease, despite an increase in the number of EV sales. This highlights the transitional challenges companies face as they navigate the complexities of shifting consumer preferences and regulatory landscapes. These counterintuitive insights illustrate the complexity of the current economic landscape and challenge prevailing narratives about stability and growth in traditionally robust sectors. Companies must navigate these dynamics carefully, balancing short-term pressures with long-term strategic investments to maintain competitiveness and sustainability in the ever-evolving market environment. The anticipated 30% revenue decline in the automotive, electronics, and pharmaceutical sectors by Q4 2025 carries profound implications for global competitiveness. Yet several critical elements within the report may be overlooked by stakeholders. Understanding these nuances is essential for strategic planning and successful adaptation to the evolving landscape. 1. Overlooked impact of regulatory changes. One of the most significant yet often underestimated factors is the influence of anticipated regulatory changes in the pharmaceutical sector. While many view pharmaceuticals as resilient, the report indicates that shifts in healthcare policy and increased pricing pressures could drastically affect revenue streams. Most stakeholders may focus solely on immediate market dynamics, neglecting to prepare for long-term regulatory frameworks that could reshape pricing and access to medications. Significance: regulatory changes can lead to substantial shifts in market dynamics, including altered competitive landscapes. Companies that fail to anticipate these changes may find themselves at a competitive disadvantage, lacking the agility to adapt to new pricing models mandated by governments focused on healthcare cost management. 2. The transition to electric vehicles (EVs). The automotive industry's transition to EVs is highlighted as a critical growth area. However, the nuances of this transition are often oversimplified. The report indicates that while there is potential for growth in EVs, factors such as the cessation of government subsidies and changing regulations could dampen consumer demand. Significance: the interplay of consumer behavior, regulatory frameworks, and technological advancements creates a complex environment. Companies heavily invested in traditional internal combustion engine (ICE) vehicles may experience more significant disruptions if they do not pivot to embrace EV technology. Stakeholders might not fully grasp the urgency of transitioning their business models to align with regulatory expectations and consumer preferences towards sustainability. 3. Economic volatility and geopolitical tensions. The report discusses economic factors such as interest rates and inflation, but underlines the potential for geopolitical tensions to exacerbate these issues. The anticipated effects of global elections in 2024 on trade policies and international relations could have far-reaching consequences for supply chains across all three sectors. Significance: stakeholders often underestimate the impact that geopolitical instability can have on supply chains and market access. Companies that do not actively monitor and adapt to these changes may face disruptions that could hinder their operations and competitive positioning. An understanding of these dynamics is crucial for effective risk management and strategic planning. 4. Supply chain resilience versus optimization. While the report indicates that supply chain challenges have eased since the pandemic, it emphasizes a shift from resilience to efficiency. However, many organizations may overlook the importance of maintaining resilience while optimizing costs. The report suggests that companies are moving toward balancing these two aspects but doesn't stress the risks of overly prioritizing cost optimization at the expense of resilience. Significance: in a climate where unexpected disruptions can occur, companies must ensure that their supply chain strategies are not solely focused on short-term savings. A resilient supply chain is essential for weathering crises, and a failure to balance efficiency with adaptability could lead to long-term vulnerabilities. 5. Labor market dynamics and talent shortages. The report emphasizes ongoing challenges in attracting and retaining talent in manufacturing, which is critical for operational success. However, the potential for a significant skills gap, exacerbated by an aging workforce and changing employee expectations, could be underestimated. Significance: companies that do not prioritize workforce development and employee engagement may struggle to maintain operational efficiency as demand rebounds. The long-term sustainability of organizations hinges on effectively addressing talent shortages and creating a workforce equipped for future challenges. Failure to acknowledge this could lead to increased turnover and operational disruptions. 6. Clean technology investments. Clean technology investment is presented as a beacon of hope amidst declining revenues. However, there is an underlying complexity regarding the sustainability of these investments, given the potential for fluctuating government incentives and changing consumer behavior regarding electric vehicles and clean technologies. Significance: stakeholders might focus solely on current trends without considering the cyclical nature of clean technology investments. Understanding that these trends could be influenced by political and market dynamics is vital for making informed investment decisions that align with long-term sustainability goals. 7. The role of innovation in navigating challenges. The report highlights the urgency for innovation and digital transformation across all sectors. However, the specific strategies and technologies that companies should prioritize can often be vague. Stakeholders may overlook the need for targeted investments in areas that promise high returns, such as artificial intelligence, machine learning, and smart manufacturing technologies. Significance: companies that do not adopt a proactive approach to innovation risk falling behind their competitors. By focusing on high ROI use cases and integrating advanced technologies into their operations, businesses can enhance productivity and efficiency in a challenging environment. Those that underestimate the importance of these investments may find themselves ill-prepared for future market demands. Conclusion: the anticipated revenue decline across the automotive, electronics, and pharmaceutical sectors by Q4 2025 presents a complex landscape that requires stakeholders to look beyond surface-level trends. By understanding and addressing the overlooked factors discussed above, companies can better position themselves to navigate the challenges ahead. Strategic foresight and adaptability will be essential in maintaining competitive advantage in an increasingly volatile market environment. 1. Impact of economic factors on revenue decline. The anticipated 30% revenue decline in the automotive, electronics, and pharmaceutical sectors by Q4 2025 can be attributed to a variety of economic factors, including reduced consumer spending, inflation, and rising interest rates. The automotive industry in particular has reported significant drops in production and earnings due to high fixed costs and increased competition from electric vehicles (EVs). The economic environment is further complicated by geopolitical tensions and trade policy changes which can influence supply chains and market dynamics. Understanding these economic pressures is crucial for firms to strategize effectively and mitigate risks in a declining market. 2. Regulatory changes and their implications. In the pharmaceutical sector, anticipated regulatory changes are poised to have a substantial impact on revenue streams. As governments push for cost management in healthcare, there could be increased pricing pressures that affect profitability. Similarly, the automotive industry faces challenges from stringent emissions regulations in Europe, which may necessitate significant investments in EV technology and compliance measures. Analyzing how companies adapt to these regulatory challenges will be essential for maintaining competitiveness and profitability in the face of evolving market conditions. 3. Shift towards clean technology and innovation. Despite the projected revenue declines, there is a notable shift towards investment in clean technologies and innovation across these sectors. The automotive industry's pivot to electric vehicles represents a significant opportunity for growth even amidst overall declines. The clean technology sector saw over $31 billion in investments in 2024, indicating a strong commitment to sustainability. Companies that successfully integrate innovative practices and technologies such as AI and smart manufacturing solutions may find ways to enhance operational efficiency and resilience, positioning themselves better for future market conditions. 4. Strategic responses to competitive pressures. The need for adaptation in response to increased competition is a common theme across all three sectors. Automotive companies are re-evaluating their production strategies and cost structures while simultaneously increasing investments in EV technology. The electronics sector is focusing on innovation and cost management to combat reduced consumer spending and inventory challenges. Meanwhile, the pharmaceutical industry may need to explore new business models or partnerships to navigate regulatory changes and maintain market share. An in-depth discussion on strategic responses will provide insights into how companies can leverage their strengths and capitalize on opportunities to remain competitive in a challenging landscape. These points encapsulate the complex interplay of economic, regulatory, and competitive factors that will shape the future of the automotive, electronics, and pharmaceutical industries, offering fertile ground for analysis and discussion. 1. The Great Depression and its impact on the automotive industry. 1929 to 1939. The Great Depression led to a drastic decline in consumer spending and significant unemployment, severely affecting the automotive industry. Major manufacturers such as Ford and General Motors faced unprecedented drops in sales, prompting them to cut production, lay off workers, and even shut down plants. Ford's production fell from over 1.5 million cars in 1929 to just over 300,000 in 1932. This period highlighted the vulnerabilities of the automotive sector to economic downturns and spurred changes in business strategies, including diversification and innovation in product offerings. 2. The dot-com crash. 2000. The burst of the dot-com bubble resulted in a significant decline in technology stocks, which led to a broader economic slowdown. Companies in the electronics sector, particularly those involved in internet technologies and telecommunications, experienced drastic revenue declines. Notable companies such as Cisco and Nortel saw their market valuations fall by over 80%. This crash prompted many firms to reassess their business models, focusing on sustainable growth and profitability rather than rapid expansion fueled by speculative investments. The aftermath led to increased emphasis on transparency, operational efficiency, and innovation in product development. 3. The 2008 financial crisis. The financial crisis had far-reaching effects across various sectors, particularly automotive, electronics, and pharmaceuticals. The automotive industry faced bankruptcy for major players like General Motors and Chrysler, which required government bailouts to survive. In the electronics sector, firms like Sony and Panasonic struggled with declining consumer demand and rising competition from lower-cost manufacturers. The pharmaceutical industry also faced challenges as healthcare spending decreased and regulatory pressures increased. The crisis underscored the importance of adaptability and innovation, leading to strategic shifts in how companies approached product development. Supply chain management and market positioning in the following years. By Q4 2025, the automotive, electronics, and pharmaceutical sectors are projected to experience a significant revenue decline of approximately 30%. This downturn is anticipated due to several interrelated economic, competitive, and regulatory factors which will impact the global competitiveness of these industries. Automotive industry outlook. The automotive sector has been facing declining demand, particularly in major markets such as Europe, North America, and China. In 2024, U.S. automotive production dropped by 5%, with major manufacturers like Volkswagen and BMW reporting staggering profit decreases of 63.7% and 61% respectively. High fixed costs, increasing competition from electric vehicles (EVs), and shifting consumer preferences are primary contributors to this decline. The ongoing transition to EVs is crucial for the industry, but challenges remain. Regulatory changes in Europe and the removal of government subsidies for EV purchases threaten to stifle consumer demand. The competitive landscape is further complicated by the rise of cost-effective EV manufacturers in China, which could exacerbate revenue declines for established players. Electronics sector challenges. Similar to the automotive industry, the electronics sector is grappling with reduced consumer spending and mounting inventory levels. Companies are likely to revise their strategies, emphasizing innovation and cost management to cope with the downturn. As discretionary spending tightens, demand for consumer electronics may decline, necessitating a shift in product focus and marketing strategies. Pharmaceutical sector dynamics. Traditionally viewed as resilient, the pharmaceutical industry is not immune to the anticipated revenue declines. Key factors include potential regulatory changes and evolving healthcare policies that could increase pricing pressures. The focus on cost containment by governments is likely to impact pharmaceutical revenues, especially if pricing negotiations become more stringent. Economic and regulatory influences. Global economic conditions, including interest rates and inflation, will play a critical role in shaping the future landscape. While a reduction in interest rates may stimulate investment, the overall economic climate remains unpredictable, exacerbated by supply chain disruptions and labor market challenges. Geopolitical tensions and shifts in trade policies following the global elections in 2024 could further complicate the competitive environment. Investment in innovation and technology. Despite the anticipated revenue decline, there is a strong push towards innovation, particularly in clean technologies. Investment in EVs, artificial intelligence, AI, and smart manufacturing solutions is expected to provide new growth opportunities. In 2024 alone, the clean technology sector received over $31 billion in investments, highlighting a commitment to sustainability and technological advancement. Common themes across sectors. Across the automotive, electronics, and pharmaceutical sectors, the need for adaptation to a rapidly changing environment is evident. Companies must prioritize digital transformation and sustainable practices to enhance operational resilience and improve customer engagement. The urgency for innovation and cost-effective solutions will only intensify as these industries grapple with declining revenues. Future predictions. 1. Revenue recovery post-2025. While the projected decline is alarming, the potential for recovery exists post-2025, especially if companies successfully pivot to focus on EVs and digital technologies. The U.S. automotive market in particular may see a rebound if interest rates decrease and consumer demand stabilizes. 2. Increased regulatory scrutiny. Expect heightened regulatory scrutiny across all sectors. Governments may impose stricter environmental regulations and pricing controls, which could impact profitability. Companies will need to proactively engage with regulators and adapt to evolving compliance requirements. 3. Competitive landscape shift. The competitive dynamics will likely shift as emerging companies, particularly those focusing on EVs and clean technologies, gain market share. Established companies may need to form strategic partnerships or pursue mergers and acquisitions to remain competitive. 4. Focus on digital transformation. The urgency for digital transformation will escalate. Companies that invest in AI data analytics and smart manufacturing technologies will likely emerge as leaders. This transformation will be essential for improving efficiency and responding to market demands. 5. Sustainability as a key driver. Sustainability will become a pivotal factor influencing consumer choices and corporate strategies. Companies that prioritize sustainable practices and demonstrate commitment to environmental responsibility are likely to attract a loyal customer base. 6. Workforce challenges. The talent gap will persist, necessitating innovative approaches to workforce development. Companies will need to invest in training and upskilling to prepare employees for the future of work, particularly in high-tech and clean energy sectors. 7. Global supply chain reconfiguration. Companies will continue to re-evaluate and restructure their supply chains for resilience. This may involve nearshoring production and diversifying suppliers to mitigate risks associated with geopolitical tensions and trade uncertainties. Conclusion. The anticipated 30% revenue decline across the automotive, electronics, and pharmaceutical sectors by Q4 2025 highlights a critical juncture for these industries. Companies must adapt through strategic innovation, investment in technology, and a commitment to sustainability to maintain global competitiveness. The future outlook presents both challenges and opportunities, necessitating a proactive approach to navigate the evolving landscape successfully.